Okay, can you hear me, Marie? Okay. Good morning. Let's go ahead and get started. I think I'm making progress on the technological challenges in this course. I was talking with the producers and the IT people yesterday for about an hour. And it's a very simple task. All I want to do is write on the board. That's all I want to do is write on the board. And we've been having issues with that, but I think we got it figured out now. So I'm going back to the smart board today. I'm going all in on that, and I'm going to continue with that until it lets me down one more time, and then if it does, then we'll proceed from there. So what I'm learning is these big classes, there are a heck of a lot more little things that can go wrong than there are with a class of, say, only 70 students in it. So anyhow, few announcements. We had a couple emails about this on Connect. If you look, I had a whole bunch of homework assignments posted on there, and they're now not on there, and that's because they haven't been assigned yet. And what I'm going to do is I'm going to release them as we go along. I'm not real sure how this semester, I'm not real sure how long it's going to take us to get through the respective material. So I want to release them at the right time, which is what happened on the very first homework set. It got released earlier than I had intended it to. So that's why they're not on there. I'll release them as we get to them. Okay. So but of course all the ones for exam 1 are on there. So had a few emails about that. Also, be reminded that our TA hours are generally 10 to 4:30, but on Wednesday, the exam opens up on Thursday. On Wednesday, they'll probably have some extended hours, depending on how many people are up there. Okay, if 4 or 4:30 rolls around and there's nobody up there, then they'll close up shop and head home. But if there's still people up there, then they're going to stay a little bit later on Wednesday to help you guys out. So just an FYI on that. They'll probably have some extended hours on Wednesday. The exam opens up 7 o'clock Thursday morning, so we will not have class on Thursday. So there'll be no lecture, no class on Thursday. We will have class a week from today, next Tuesday, even though the exam doesn't close until midnight on Tuesday. So this should be, I believe, the only time during the semester where we'll actually have a class while the exam is still open. Please understand that the testing lab and the volume that they deal with is beyond my control. Okay, there's nothing I can do about it. So in this particular case, what I wanted to do was I wanted to close the exam on Monday, and I couldn't because they had other exams closing on Monday. In fact, I posted, if you look on Canvas, I posted the statistics that they actually sent me. And on Monday, I don't remember exactly what it was, but on Monday they have like 3,800 exams closing on Monday, or something crazy like that. So please understand, that's beyond my control. There's just nothing I can do about it. All right, it's the hand we've all been dealt. So nothing I can do about it. On a related note, and this is very, 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 very important. So if you don't hear anything else I say this morning, hear this: don't procrastinate. Okay, don't wait until the last minute to go in there and take the exam on Tuesday, because if you do, look on the statistics that I posted on Canvas. If you do, there is a possibility that there's not going to be a seat for you in there, and then the exam is going to close, and you're out of luck. Okay, again, it's beyond my control. I'm sorry about that, but it's beyond my control. The exam is going to be open for, I believe, 5 days: Thursday, Friday, Saturday, Monday, and Tuesday. Okay, it's going to be open for 5 days. You can also take it at the 4 regional campus locations, so you can make an appointment out there to take it. So don't wait till the last minute on that. All right, if it were me, I'd be taking it earlier rather than later. Okay, I will talk about the exam at the end of class today. So let's hold exam questions until then, please. But I wanted to give you that administrative note on the exam. Is it administrative or content? Go ahead.
My question is regarding study.
I'll talk about the exam at the end of class, so let's get back to that then. Was it, yeah. Oh, do we have a game this Saturday? Oh, that's okay, so the testing center's not open on Saturday. All right, so nonetheless, Thursday, Friday, Monday, Tuesday, don't wait till the last minute, okay? If this was, understand, okay, there are disadvantages to lecture capture format of doing a class, but there's also advantages, going back and rewinding, looking at, at your leisure and all that kind of stuff. Understand, if this was not a lecture capture class, your exam would be Thursday at 9 o'clock in the morning. That's when it would be. That's why we're not having class, so you can go take it at that time. All right, so the fact that you can take it Friday, Monday, that's actually in my mind, that's actually taking the exam late. Okay, you're getting extra study time to study for it. All right, so in these big classes, there's advantages and disadvantages. So thanks for pointing that out. But nonetheless, it's still open for 4 days. Don't procrastinate because it could lead to very bad consequences. Okay, all right, and I'll talk more about the exam when we finish our material today. I'll talk more about the exam at the end of class today. Okay, so we'll have class on Tuesday. I will update the grades on Wednesday, but there's a grade issue with Connect, and it has to do with McGraw-Hill, and I need to get with them on that. It's not it's not paired correctly, and if you'll notice, the homework grades that you've been doing on Connect, your grades are on Connect, but they're not in Canvas yet. All right, and the reason for that is because it's not paired correctly with McGraw-Hill. We're going to straighten that out on Wednesday, maybe Friday, but probably it'll be Wednesday before we get that all straightened out. So on Wednesday, we'll get everything uploaded on there, I hope, and then that will reflect your grade in the course at that time. Okay, so that's another one that's kind of out of my control there because it's a McGraw-Hill issue. Okay, so those are the main announcements. Just standard reminders. Videos close next Thursday. TA hours already mentioned. If you're going to contact us, make sure you email us at the ACG3173 account, please. And just a reminder, especially going into the exam, of course, the last homework set is due Thursday morning. But just a reminder, because we're still having quite a bit of problems with this, is the tutors are up there to help you understand the material. They're not up there to do your homework for you, okay? And you don't want them to do your homework for you because the purpose of doing the homework is a couple purposes. The main one, of course, is to help you understand the material. It's also to get you to read the book. Okay? That may sound funny, but you'd be shocked. I mean, I've been fighting this my entire career. I don't know why it still shocks me. I've been fighting this my entire career. Part of the reason for the homework is to get you to actually study the book. It kills me. In fact, it kills me when I teach like senior level courses, and I get the occasional, not very many, but the occasional email from a student, hey, do we really need the book for this course? Yes. That's why it says required on the syllabus, okay? So be reminded that their job is to help you understand the material, not to do it for you. And the other part of that, what I was going to say, is you want to do that. Okay, because the homework questions are each individual question is a very, 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 very small percentage of your overall grade. Okay, what's a much bigger percentage is the exam questions. All right, so you want to do the homework so you get it right on the exam. That's what it's about. That's what you're supposed to be doing, okay? So don't worry about the points on an individual homework question. Worry about the points on the exam. All right. So anyhow, just a reminder on that. And like I say, I have some exam stuff to talk to you about, and I will save that towards the end of class today. So questions about anything other than the exam? Questions? Yeah.
I ordered my hardcover book, but the bookstore they said they will never have the hardcover. So
The bookstore will never have what?
Hardcover.
Yeah, I don't think the bookstore is ordering the hardcover. I'm not real sure. I believe you need to order that from McGraw-Hill, but you still have access to the ebook. When you get your Connect Access code, you have access to your ebook. With the bookstore, I don't anticipate them ordering hardcover because very few people actually want to do that. I'm with you. I'm with you on that. I would too. I like holding but I don't think they're going to be ordering. Yeah, no, I'm with you. Order it online. Yeah, order the book online. It'll be delivered right to your doorstep. Yeah, and there's some. If you look in there, and if it's really an issue, email us and we'll connect you with our book rep. But if you look in McGraw in that Connect Access code, there should be there's some packages in there. So look in there, and there should one of the options in there should be to buy the hardcover.
As soon as you get into Connect, it will pop up screen saying if you want the hard copy, it's something extra $15.
Okay. Yeah, there you go. So it sounds like something pops up in there. Sounds like she knows what she's talking about. So, other questions? Yeah. Uh-huh. Okay, she rented the hardcover book off Amazon. Okay. Other questions or comments? Helpful comments. Questions? Okay, that it? All right, good. Then let's go ahead and continue on. I noticed this right before class. This is out of USA Today, talking about what we're talking about in this course, which is the importance of accounting issues. And I don't know that they directly address it in here, but this is also This helps us to understand the importance of the audit function. Okay, we talked about that back in chapter 1, I believe it was. All right, so we as decision makers are looking at financial statements because maybe we're looking to invest in the stock. All right, well, how do we know whether or not those financial statements are worth the paper that they're printed on? Okay, well, for publicly traded companies, they're required to have an audit. Okay, the auditor, third party, okay, at arm's length, comes in and makes sure that the financial statements are. Anybody remember? Yeah, and what are the standards that they meet? GAAP in all material respects. Okay, so they state an opinion saying that the statements fairly present the financial position according to GAAP in all material respects. Okay, and if it's just a clean opinion, if it's just good to go, then that's called an outstanding, an unqualified opinion. Okay, and that's what you want to look for on the auditor's report. Okay, and this kind of underlines the importance of that. Like I said, I don't know that they specifically talk about the auditors in here, but what they did say was that they found problems with the way the company was booking revenues. All right, and this is something that we're going to talk about a little bit in chapter 8, or actually I think it's chapter 9, somewhere back in there. We're going to talk about the timing of revenues a little bit, because remember, exam review, revenues are recorded when they are earned, regardless of when they are received. Okay, well, probably most of the time it's obvious whether or not a company has earned the revenue, but sometimes it may not be. So the question is, well, have they really earned it now, or did they not earn it until January? And that's when these kinds of things pop up. Okay, and the stock price took a 16% hit as a result of this. Okay, so like I said, I just ran across this this morning, and it was related to what we're talking about in here. Okay, all right. So what we've been talking about is bad debt expense. We're talking about 2 ways. Well, actually, there's more, but primarily 2 ways that companies estimate their bad debt expense. Those are the percentage of sales, okay, where the focus is on the income statement. Okay, the focus is on bad debt expense, where they're going to go and say, okay, well, of our sales for this period, we estimate that 2% of them will be uncollectible. So they will make this entry right here for the 2%, however much that turns out to be, and that's it. As opposed to the other method, which is the outstanding, the aging method, okay, which is focused on the balance sheet. Okay, that's where they're going to, instead of looking at the sales this period, they're going to look at how old their receivables are. Okay, and the theory is the older the receivable, the less likely they are to collect it. Okay? And therefore, what they're going to do is they're going to adjust the allowance account based on that. Okay, so under the percentage of sales, the focus is on bad debt expense. Under the aging method, the focus is on allowance for bad debt account. Okay, and that's where on the aging method you could actually see the reverse of this entry, where they're actually debiting the allowance and crediting the bad debt expense, noticing that that would reduce bad debt expense and increase income, which is kind of odd if you don't know the underlying theory. Okay, so you're looking at an income statement, you see negative bad debt expense. Say, how the heck can that happen? Okay. Well, okay, so we talked about that. This is the entry that they make to estimate that. Like I say, it could be reversed under methods. This is basically how you will see it on the financial statements, although I pointed out last time that you usually don't see these first two lines. Really, all you see is something to the effect of net accounts receivable. That's what you'll see on there. If you look back on the Facebook financials that we looked at a few sessions ago, you'll see those on there as well. Always pay attention to the word net. Okay. All right, and what I believe I left you with last night was this problem. Okay, now, I've solved my tracking issues up here, so I can actually write on here, but nonetheless, my handwriting isn't the greatest in the world, so if I write something up here that you can't read, please ask me about it. I will not be offended, okay? So I believe we left off at this point where we're looking at 2015, I guess it was. I don't remember the years I used last time, but it doesn't matter, okay? So beginning assets, $200,000, ending assets, $220. Net income for 2015 was $30,000. Okay, and they estimate bad debt expenses to be $2,000 for 2015. Okay. So the question is, calculate the return on assets. All right, so let's say you're running your business. All right, the accounting department has brought you the preliminary financial statements. Okay, this is what's on there: $200, $220, $30,000. Okay, but as you're talking to them, you happen to notice, well, hey, there's no bad debt expense on here. Why not? And they say, oh, I'm glad you caught that. We forgot to put it on there. Okay, we forgot to estimate it. So we estimate it. So question is, what would return on assets be if that was not corrected? And what is the correct return on assets? Okay. Well, first of all, how do we calculate return on assets? Okay. So return on assets is net income over average assets. Average assets. Okay. So before the adjustment, all right, now I feel like I'm cooking. Whew. All right, before the adjustment, net income is $30,000, and average assets would be $210. Okay, because beginning is $200, ending is $220, so add those together, divide by 2, and you get $210,000. So their return on assets, if this was not corrected, would be 14.29%. Yeah. Well, that's a good question. On the exam, what you want to do is you want to be as accurate as possible on the calculator and round to what I have on the exam. Okay? The Hewlett-Packard calculator takes 9 decimal places. If you look on, I have some basic videos on there. One of them shows you how to change it to 9. I highly recommend you set it to 9 and just leave it that way all semester. So that's a good question, okay? And also, on just like in the homework, on some of the questions, you'll see in my instructions, round your answer to 1 decimal point or 2 decimal points or what have you. Okay? All right, yeah. 210,000. This is the average assets. So beginning assets 200, ending assets 220. So add those together and divide by 2. Yeah. Okay. Yeah. For 3403, what?
I have to leave the financial calculator at 4 places. Can I get by there with 4 places?
I reckon the question is, can you get by with only 4 decimal places? What I recommend doing is setting it to 9. Be as accurate as possible. So setting at 9. I haven't tested to see whether or not 4 would get you there or not, but I'd set it to 9. I'm trying to look out for you. Set it to 9. Okay, so far so good. Oh, yeah. For as far as what you should know on the calculator, if you can do all the homework, you're good to go for the exam. Okay. Now, when we get to chapter 6, actually it's chapter 7. Then we'll be doing some more sophisticated things with the financial calculator, which is why I encourage you guys to get it back in week 1 so you learned how to do the basic things, okay? But if you can handle it on the homework, you can handle it on the exam, okay? Okay, other questions? Okay, oh yeah. No, it needs to be a financial calculator. Financial calculator. All right, other questions, preferably about the material. Okay. All right, so this would be the return on assets if the error was not corrected, okay? So afterwards, so if they correct the error, then net income will be net income is going to decrease to $28,000 because they're booking $2,000 of expenses. Yeah. So net income will be $28,000. And what about our average assets? Will that change? Yes. Why? Not accounts receivable, but outstanding. The allowance for bad debt. Remember, this account right here, killing me. This account right here is called the allowance account's called a outstanding. It's contra asset, which means it decreases assets. Okay? So when they make this entry here, the allowance account is going up, therefore assets are going down. Right? So, back over here, $28,000 in net income, so our beginning all I want to do is write on the board. That's all I want to do. So, beginning assets are $200,000. Ending assets, that's supposed to be a plus sign, will be $218. $218. Okay. So that will be our average assets with the adjustment. Okay, with the adjustment. Okay. So our return on assets afterwards, 13.40%. Okay, yeah. Because the 218 comes, the ending assets are $220,000, but they're booking $2,000 into the allowance account. So ending assets will drop from 220 down to 218. Okay. Other questions? Other questions? Okay, so this is an example of a situation. This is something I think I've been talking about all semester. I know I've mentioned it a couple times. The difference between what you might see on the homework and in lecture and what you might see on the exam. Okay, the question here that we were dealing with was ROA. And what you should understand, the important part of this is how bad debt, in this case, how a transaction is going to affect the information that we as decision makers use. Okay? That's the overriding goal in this entire course. So that's kind of your perspective for just about everything we do in here. All right? Well, in this case, we're looking at how bad debt expenses affects ROA. Okay? What I could do is on the exam is say, well, how does it affect ROE? Well, the thinking is still the same. Okay? Well, net income divided by average equity. All right? Well, how does this transaction affect net income? How does this transaction affect equity? And you just go through the numbers. Okay? That's the difference between memorizing these steps and actually understanding what's going on. Okay? So I'd encourage you to make sure you understand what's going on. Okay? All right. Also notice that ROA is decreasing. Notice that there's no cash changing hands here. Okay? This is a non-cash transaction that's still affecting income and therefore the return on assets. Okay? Yeah?
So is it only assets and net income that's affected by bad debt?
Well, all right. Well, the question is it only net income and assets that are affected? Okay. Well, again, here's the entry. So what accounts are being affected here? Bad debt expense, of course. So is that affecting assets? It's affecting net income, so is it affecting assets? No. Is it affecting liabilities? No. Is it affecting equity? Yes. Because this gets closed out to retained earnings, so equity would go down. Okay. The allowance account, is this affecting the income statement? This is an important question. Is this affecting the income statement? No. Is it affecting assets? Yes. Is it affecting liabilities? No. Is it affecting equity? No. That's the thought process right there for everything we do this semester. For everything we do this semester. That's why I gave you the review material on chapter 4. Okay, where you have a whole list of transactions and you're putting it in the horizontal model to see how that transaction affects the income statement or affects the financial statements. Okay, that's what that was all about. So that was an important question because that's the thought process you should go through all semester long. Because you're running your business, okay? We're decision makers. You're running your business. Or you're thinking about investing in that stock that I just showed you a few minutes ago. All right? In your business, and you can take this one to the bank, you're thinking about making a decision, okay, investing in something or what have you. It's very important to understand how that's going to affect your financial information. How's that going to affect your return on assets, your return on equity, okay? Even if it's not for you, if for the shareholders. Because if you're running a publicly traded business, all right, then the signaling effect, you'll talk about that in 3403. The signaling effect is important, so you need to understand how what you're going to do is going to send a signal to the market. Because that signal will either drive your stock price up or down. Okay? So that was an important question because that's a thought process that you should go through with pretty much everything we do in here. Okay? All right, so that is... And they give on the slides here, which as you know are from the publisher, they go through another example, which is essentially the same one that I gave you, just with different numbers. Okay, so they're using $500. Notice they talk about when the account is actually written off. Okay, so in their example, they're writing off an account of $500. What we just did was deal with the estimate of bad debts. Okay, well, the next step in that is, well, what happens when a company finds out for sure that their debt is bad? Okay, they know a specific account that is not going to be collected. What happens then? Okay, well, this is what happens then. Okay, they take the account receivable off the books and they take it off against the allowance account. Okay, so same thought process. Allowance, what kind of an account is that? Contra assets, so it's an asset account. Accounts receivable, what kind of an account is that? Assets. So an asset's going up and an asset's going down. Therefore, what's the net effect? Zero.
What happens if you write something off but then you end up retaining something or they're maybe not?
Okay, that was a question that was asked last time. So exam review. Let's say 2 more months pass. This Jay Clark, whoever that is, says, all right, I'm sorry. I was wrong. I'll pay you your $500. Okay? I went over this last time. What happens? Exam review. Yeah.
Another journal entry for receiving the money that you paid as crediting the account.
Okay. I know what you mean, so I'll give you credit for that. Simply, what the company will do is undo this entry. Okay? So they'll reinstate the receivable, and then they'll collect the money. So they'll debit cash and credit. So they'll reinstate this, and then they'll debit cash and credit accounts receivable for the $500. I know that's kind of small, but I'm having to squeeze it in there. Okay, so that's what happened. Okay, yeah. Well, the question is why wouldn't they just skip a step and do it in one entry? And actually, they may very well do that. I didn't want to get into all that because this isn't an accounting class, but to answer your question, the reason you might want to do this in the real world, in your company, in QuickBooks, the reason you might want to do this is to leave a clear trail as to what you did. So that 18 months from now, when you're going back and looking and you've long since forgotten about Jay Clark, and you're trying to figure out what happened, you're leaving a clear trail. That's the real reason, but they may very well just do all this in one step. Okay. All right. So that's what we just, so this is what I was just telling you, okay? Asset goes up, asset goes down, so the net effect on assets is 0. Okay? So that's kind of the whole process with accounts receivable, okay? What you'll see on there. And one final note on that, I believe I mentioned this in the beginning, but understand that estimating bad debt expense like this, the company's only going to do that when they have a large number of receivables. Okay, if they have a small number of receivables, they may not do that. Or even if the dollar amount of receivables is very high, if those receivables consist of 3 accounts, they're not going to estimate bad debt expense like that. Okay, they're going to use a specific identification. So if there's only 3, if 4, okay, if these 4 people on the front row represent all of the receivables, it's very easy to confirm. Hey, do you owe them $150,000? Yes, I do. Do you owe them $250,000? Yes, I do. So forth and so on. Okay, so they wouldn't go through all this. So this is only going to be when they have a large number of receivables. Okay. All right. So that takes care of accounts receivable, and next is notes receivable, okay? So as you know, this is where a company's doing something that's a little out of their ordinary course of business. So they're lending money to someone for one reason or another. All right. Therefore, they have a note receivable, and there's usually, in fact, I'll say almost always going to be interest associated with that. Okay? So note receivable, we've talked already about that. Understand that the example that I'm getting ready to show you in just a minute is assuming they have a note receivable that's due in a year. Okay, so a company lends money, all right, and then a year from now they're going to receive their money back plus interest. All right. Well, along the way, they've been earning that interest. So let's say that it's a 12-month receivable, but it was lent at the beginning of October. So October, November, December. So at the end of the year, they've earned 3 months. Pay attention to accrual accounting exam review. Okay, at the end of 3 months, they've earned revenue, but they haven't collected it yet. Okay. So what the company will do is they will record the interest accrual using this entry right here. So they will create an account, okay, interest receivable, because in my example, 3 months through the year, they've earned that interest, so they are owed that interest, okay? So they have the receivable, but it's not collected yet. If they'd collected it, then it would be cash. Okay? But they haven't collected it yet, so interest receivable, and then the interest income, which is booked into revenue, which will increase earnings because they have in fact earned it. They lent the money. Okay, so this is the interest accrual account, and notice that they're calling this accrued interest. We've talked about accrued expenses already. Exam review, what are accrued expenses? Outstanding expenses that you've incurred but not yet paid. Okay. Similarly, they're saying accrued interest. So we could say we could generalize and say accrued revenue would be revenue that you've earned and have not yet collected. Okay. All right. So this is the entry that they will make. Notice that the interest formula down here. We're going to talk about this quite a bit more when we get into chapter 7. We'll be doing quite a bit more with interest. So this is kind of an introduction into that. So, for example, let's say, I hate you. I wish they would just put a whiteboard up here and I could just use that. All right. So let's say that your company lent $25,000. Okay. $25,000. You lent it at 8% for 1 year. Okay. And let's say that this happened on June 30th. June 30th. All right. First exam question is calculate your annual interest. And by the way, very important point here, interest rates are always quoted annually. Always quoted annually. So what I'm saying here is 25 at 8% for 1 year, so they're going to earn 8% over the course of a year. Right? If the question had been they're lending $25,000 at 8% for 6 months, that doesn't mean they're going to get 8% over 6 months. Okay? It's still 8% annually. All right? Okay, so interest rates always quoted annually, very important point. All right? So the question was calculate interest. Yeah.
That means you're only earning 4% of the length?
Yeah, if it was 6 months, then you would only be earning 4% over that 6 months. Over that 6 months, and you're going to see that in just a second. Yeah.
Would that be the same thing with accounts receivable because you haven't received the revenue, but it's basically on credit?
Yeah, but in this case, it's going to be an adjusting entry. So no transaction has actually. The question was, isn't accrued, which by the way is a good question, is accrued revenue the same as accounts receivable? With accounts receivable, that's as the result of a transaction. The accrual will, there's not going to be a transaction at that time. It's more because of the passage of time. Okay. All right, and that was a good question, by the way. Okay, so back to this. So the question was, calculate annual interest on this. Well, the way we do that, our formula is very easy to remember. I equals PRT, principal times rate times time. Okay, principal times rate times time. So in this case, our principal, which is the amount available, and like I say, we're going to do a lot more with this in Chapter 7, so this is just kind of an introduction, is $25,000. Our annual rate is 8%. And the length of the loan, the time of loan, is 12 months. Okay, so there are 12 months in the year, and in this case, they are lending it for 12 months. All right. So yeah. Yeah, because it's still 12 months because the question is calculate the annual amount of interest. Annual amount of interest. I'm getting right where you're getting, but the question is calculate the annual amount of interest. Right. So the annual amount of interest would be $2,000. $2,000. Okay. So far, so good? All right. Now, the end of the year rolls around. Yeah. Because it's 12 over 12 because I'm trying to get you in a good habit, and you're going to see that in about 2 minutes. So hang on. Okay. All right. So this was June 30th. Now the end of the year rolls around. Okay. So the end of the year rolls around. You've got beginning assets of $300,000. Ending assets $310,000. And net income of $40,000. So beginning assets, $300,000, ending $310,000. Net income is $40,000. Exam question, calculate return on assets before the interest accrual and after the interest accrual. Yeah, because this was lent at June 30th. Okay, so now the end of the year was rolled around. The company hasn't received the cash yet. They haven't received the cash yet. This is just an accrual entry. They're not going to receive it for another 6 months, but they've earned 6 months worth of interest. Okay. Well, same thought process. Let me take one because I don't want to run out of time because I assume you guys want me to talk about the exam. Yeah. No. Yeah. Calculate return on assets before and after the interest accrual. Okay? All right, let me pick up a little speed here. All right. First of all, how much interest have they earned? $1,000. Because at that time 6 months has passed. All right. So what they've earned is $1,000. All right. Well, before the interest accrual, we're dealing with return on assets, so we just talked about what that is. Okay. So before, net income is 40. Average assets are 305. Okay. Therefore, return on assets before is 13.11%. 13.11%. After the interest accrual, okay, net income is $40,000 before the accrual. How will net income be affected because of the accrual? It'll increase by $1,000. Outstanding. Okay. So after the accrual, net income will be $41,000. Right. Will beginning assets be affected? No. Will ending assets be affected? Yes, they are going to go, they're going to increase $1,000. So it'll be 311, right? Yeah. $311. So after the interest accrual, return on assets will be 13.42%. Again, noticing that this does not reflect cash changing hands. This is a non-cash transaction. Okay? So their return on assets go up from 13.11 to 13.42%. Yeah. $1,000 over 6 months. Yes. Yeah. Yeah, that's what I've got right here. Because the annual interest there is $2,000. But at this point in time, only 6 months has passed. So they've earned 6 months worth of interest, which is this calculation right here, which would make this $1,000. Yeah. Yeah.
Do we ever calculate these problems as they're making payments as well?
Well, this is their loan, so they're not going to make payments. They'll receive payments. Yeah. And if they received a payment, then yes, the company would make it at that time. This accrual would be made in between payments. So let's say that for some reason they received a payment on December 15th, and the next payment isn't due till January 15th. Then they would make this adjustment for two weeks at the end of the year. Okay? All right. Okay, yeah? Is this 13.42 or 13.31? Somebody else. Is this 13.42 or 13.31? What, did you got 4.2? Okay, I got 4.2 as well.
Where'd you get 305 from? Well, no, I see that, but where's it?
Now, look, the beginning assets, the average assets, beginning is 300, ending is 310, so the average is 305. Okay. As a result of the accrual, ending assets go up to 311. So 611 divided by 2, dividing into 41, should be 13.42. Okay. I don't know how else to explain it. This is before the interest accrual. That's before the interest accrual. Yeah.
What about the accounts receivable? Because what do we still be on $1,000 in revenue? I mean, in interest, wouldn't we still be?
Yeah, but it's not accounts receivable. You are owed. The company is owed $1,000, but it's not accounts receivable. It's interest receivable, which is why assets are going up from wherever we are, 300 to 310 to 311. It's going up for that $1,000. Yeah. So notice. I'm playing with all the pin colors up here. Notice that income goes up by $1,000. All right. And the ending assets were 310, but as a result of the interest receivable of $1,000, that goes up to 311.
Weren't we already paid $1,000?
No, you were not paid $1,000. That's actually the point. Is the company hasn't received the $1,000 yet. Okay? So let me summarize this one last time, okay? So, this is what happened, all right? The company lent $25,000 at 8% for 1 year on June 30th. Okay? So the transaction is your company. You lent someone $25,000, and in 1 year, they're going to pay you back your $25,000 plus interest. So you're not going to receive anything for a year. Okay? So far, okay. So that happened at June 30th. December 31st rolls around. You haven't received anything yet, which is fine because you're not expected to receive anything for another 6 months, but you're preparing, your accounting department is preparing the year-end financial statements. Okay? As a part of that preparation to most properly reflect the underlying economic reality of the firm, okay, you have earned $1,000, okay, because the annual interest is $2,000. You've earned $1,000 of that, but you haven't received it yet. You haven't received it yet. Okay? So before making this adjustment, net income is $40,000, and average assets is $305, which is the average of 300 and 310. With me? Okay. As a result of making the adjustment, which is the debit to interest receivable, the credit to interest income, you've earned $1,000 worth of income. Okay. As a result of that adjustment, income goes up by $1,000, so net income goes up to $41,000. And ending assets also go up by $1,000 because of the $1,000 that you're owed. So ending assets go up from $310,000 to $311,000. Okay? So average assets would be $305,500. Okay? Into 41, which gives us ROA of 13.42%. So the information that we use as decision makers, return on assets, goes up from 1311 to 1342 as a result of this interest accrual, noticing that no cash has changed hands. Okay, does that make sense now? Are you with me? Seriously, makes sense? Okay, questions? If it makes sense, shouldn't have any questions, but. After the interest accrual. The after means after the interest accrual. Yeah, okay. Yeah. And the reason I keep doing the before and after, and you can take this to the bank, the reason I keep doing the before and the after is because in the real world, you can believe me on this one, in the real world, mistakes happen. Okay? So I'm packaging this as, well, what is it before they make the accrual and what is it after? It also could be a mistake, like we did in the previous one, where they should have estimated bad debt expense, but they forgot to do it. So how does that change the information that we need? Okay, so that's why I'm doing that. Yeah.
In the context of like making decisions, there's always the risk that they're not going to pay any of that.
That's correct. They may not get paid.
How would that affect like return on assets, current assets?
Well, the question is how would not getting paid or the risk of not getting paid affect return on assets? And the answer is to remember our definition of an asset. Okay, exam review. An asset is a resource that is expected to pay a future economic benefit. Okay? So this note, they have legal recourse on that. So loosely speaking, for our purposes, if it's expected to pay a future economic benefit, then it's a receivable. And you're good to go. If it's not expected to pay a future economic benefit, maybe they declare bankruptcy, something like that, then it would be taken off the books and you'd probably have to eat the interest. Okay? Yeah. At the end of 6 months, you're increasing what? No, you don't have to pay the $1,000 to stockholders. In fact, you haven't even received the $1,000 yet. No, it's just $1,000 in income. Yes, you are putting it down as if you made it, because you have earned it even though you haven't received it yet. Yeah, so it is, I think what you're asking, Or I think the answer to your question is the 1,000 is increasing income, most definitely. Okay? Even though you haven't received it. That's accrual accounting. Okay? If this was a cash basis of accounting, would you be doing any of this? No, because you haven't received it yet. Okay? So this is part of accrual basis. Okay? I'm kind of working my way across the room. Other questions? I thought I saw it. Yeah.
I think what he was asking was, even though you're reporting the income,
Okay.
you have to pay stockholders.
Oh, well, was that what you're? Okay. Yeah, the question is, because you received the income, do you have to pay stockholders?
Right, because you don't actually have the cash, but we do because it's accrual.
Yeah, and that's a whole long-winded answer that you'll cover in 3403, but the short version is this. Are corporations required to pay dividends? No. So they don't have to pay stockholders squat, regardless of whether they collected it, earned it, or not. They don't have to pay them squat. That's part of a company's dividend policy and a big topic in 3403. But no, they don't have to pay them anything. But yeah. The company will generally have to pay taxes on it, yes. Yeah, but that doesn't mean they have to pay it out to shareholders. In fact, I've heard this once, and I never bothered to look at it, but I believe it. Most companies inside the S&P 500 do pay dividends. Most companies outside the S&P 500 don't pay dividends. They don't pay them at all. Okay, Apple just recently started paying dividends. They didn't pay a dividend for 20 years, and they have however many billions of dollars in cash. Okay, yeah. All right. How is stockholders' equity affected with this? Or is stockholders' equity affected as a result of this transaction? It is because, exactly. Remember, net income is going to be closed out to retained earnings. All right. So this 1,000, so equity will increase by the $1,000. Okay. On kind of a side note, let me not get into that. Equity will increase by 1,000. Okay. All right, other questions? And these are all good questions. I'm very happy that with the gazillion students that I have, we can still come in here and actually have a dialogue about the material. I'm very happy about that. I'm very happy that I'm finally overcoming the technological barriers to communicating the information to you guys. So our stock price is increasing. Okay. Questions? Going once? Twice? All right, no questions? All right. So, we talked about cash and cash equivalents. We talked about accounts receivable and primarily the bad debt expense associated with that. Next item down the balance sheet, generally notes receivable. Okay. So we talked about the interest accrual associated with that. So we're all good to go with that. Okay. The next item is inventory. And inventory is a big issue. So what I'm going to do is I'm going to punt inventory into the next exam. All right. So for exam 1, the material covered on exam 1 stops right here. So you can draw a big line in your notes. Okay. And this is where the exam 1 material will stop right here. Okay. Which, by the way, if you'll notice on the homework, in the title of the homework, I said Chapter 5 through Notes Receivable. Okay, so this is where the exam 1 material will stop here. We won't have class on Thursday. Class on Tuesday, we need to keep going. Okay, so on Tuesday we'll pick up with inventory and all that, which is not on exam 1, but we need to break ground with that. Okay, all right. So with that, I assume you want to talk about the exam a little bit.
Yes.
I do too. I do too. Okay, exam opens up Thursday morning at 7 o'clock. Make sure you look at the times on the Keon Testing Lab website for the exact closing time. All of the exams are open for different amounts of time. I've already been through all that, but I do want to emphasize, it's beyond my control, okay? It's just beyond my control, nothing I can do about it. So, exam. All right, so you can expect 25 questions on the exam. 25. I could put 50 on there if you want. All right. I'm here. Yeah, 25 questions. You have an hour and 15 minutes to do it, 75 minutes. And keep in mind, I went through an iteration of this course, Summer B, with a very small group of, a smaller group of students. I think there are 40 or something like that in there. So you have plenty of time on there, assuming you know what you're doing. Okay, if you don't know what you're doing, I could give you 5 hours and it still wouldn't be enough time. All right, so assuming you know what you're doing, plenty of time on there. I think the average, I don't remember exactly, but I think over the summer the average time spent on the exam was like 50 or 55 minutes, I think, something like that. So you got plenty of time there. I will emphasize again, do not procrastinate on this and wait until the last minute to take it, because they may not have a seat for you over there. All right, so don't procrastinate. I talked about that enough already. Something I've talked about before that I want to mention is that everything we've covered in here is on the, let me do that the opposite way. Everything on the exam has been covered in class or on the homework, okay? So and we haven't covered every single little thing in the book. All right, so don't come to me and say, hey, we didn't cover this in the book, so do I need to know it? All right, I'm an educator. I'm always going to encourage you to learn more, but in terms of what you'll be tested on, everything on the exam we've covered in lecture or in the homework. I've mentioned this before. Understand that the homework is not a practice exam. Okay, so a couple of implications of that. One might be what I just said, whereas on here we're talking about how does it affect ROA, but what I might ask you on the exam is how does it affect ROE, return on equity. Okay, if you understand how it works, then that's not an issue. If all you've done is memorize ROA, then it's going to be an issue. And what you want to do in here is go beyond memorization to actually understanding the relationships. Okay, that's the point. So, homework, not a practice, and there are some questions on there that were not covered in the homework, okay? But they draw from what we talked about in class, which is also in the book, okay? Most of it. So we've talked about, I think we've talked about a couple things that are not in the book, okay? But they're still fair game, all right? So be reminded of that. I've already talked about homework, so I talked about that. I talked about that. A very important point is the way that I grade multiple choice exams is I look at the questions on the exam that were missed by more than half the class. Okay? Because if more than half the class got a question correct, then that tells me that it was a good question. Okay? It was fair, the answer was actually on there, so forth and so on. Okay? If more than half the class is missing a question, then I look at that question to see where the problem is. Okay? If the problem's with you, then the question stands. If the problem is with me, maybe it wasn't as clear as I thought it was in the beginning, maybe the answer's not on there, maybe there's a rounding error on there, something like that, then I do what's fair to you, okay? I bend over backwards to be fair to you. I've done it my entire career. I bend over backwards to be, that doesn't always mean telling you what you want to hear, but I bend over backwards to be fair with you. That's the way I grade multiple choice exams. What I'm not sure about in this class is whether or not I'll be able to get those statistics, because I tried to run some preliminary statistics last week and Canvas wouldn't do it. It said something to the effect of there's too many students so we can't make this calculation. All right, I'll have to figure that out on Wednesday. So I'll stay tuned on that. I'll just have to figure that out on Wednesday. So on a related note, the score that you get on your exam, when you submit the exam, it should tell you your overall score. It's not going to tell you which questions you missed and all that for exam security purposes, but it should tell you your overall score. View that score as your minimum score on the exam, because what I'm going to do on Wednesday is I'm going to look at the overall scores. All right, and see, well, which questions are you having problems with? And maybe I could have worded it better, finding out where the problem is. And I may come in and curve the scores if it requires that. Okay, so my point is that if you take the exam on Thursday, which is really what you should do, if you take the exam on Thursday and you don't get as high a score as you wanted, don't fire off an email to us on Thursday. Okay, just cool your heels, breathe. Relax, let me take a look at them Wednesday and we'll go from there, all right? I don't know that I'm going to be able to do it Wednesday morning. Usually I do. I'm very adamant about getting grades back to you as quickly as possible. So I usually do it Wednesday morning. I've got this McGraw-Hill issue to deal with, so I'm not sure how quickly I'll be able to get it back, but it should be sometime Wednesday, I hope. All right, because I also have class all Wednesday afternoon. But I'll do my best to get it on there Wednesday. Regardless, I'll make an announcement on that. So make sure that, and also after Thursday, after the exam closes, not before, after the exam closes, if you want to come see your exam and see which questions you missed and why you missed it and all that kind of stuff, that's one of the things the TAs will facilitate for me. So come see the TAs. They'll pull your exam up on the computer, and you can look through each question, see which one you missed, ask them why, and all that kind of stuff, okay? So they will not be available while the exam is open for obvious reasons, okay, for security and that kind of thing. So they're not going to be available while the exam is open. So you have until close of business on Wednesday to come see them, all right? All right, so that's kind of the administration of the exam. In terms of the content, again, everything on there we've covered in class or it's been covered in the homework. A few things to point out. You already know one question. For a fact, you know one question is going to be on there because I've told you. And what is that? Purpose of the financial statements. Go back and look in your notes. Okay, I'm telling you it's going to be on there. All right. So we talked about that. Early on this semester, we talked, a little bit about the history of accounting. And I'm not a historian either. I thought that was kind of interesting. We talked about that a little bit. One thing that we talked about that was important that we just talked about a few minutes ago was the audit function. All right. So that's a very important part of this whole process. It's important for the economy. Remember we talked about whether or not an exchange takes place and all that? Okay, so that was a very important topic that we talked about. Chapter 2, we talked about Chapter 2 for quite a bit. Most of that should have been a review. That was actually the point of Chapter 2, okay, was to review and get you up to speed from your prerequisite courses to now. So that when we're talking about accounts receivable and notes receivable, you know what they are, and you know their current assets, and so forth and so on. Okay, so Chapter 2 should have been mostly a review, and in that review, make sure you understand that an important part, and we're going to be doing this all semesters, kind of a point of the whole course, but an important part is understanding the relationships, okay, the relationships between financial statements, the fact that, for example, we just talked about this, an increase in revenue, yeah, that increases net income, it also increases retained earnings. Okay. Company pays a dividend. Okay. Well, that decreases cash, which decreases equity, which decreases because it decreases retained earnings, et cetera, et cetera. Okay. So make sure you understand the relationship between the statements, and also make sure you understand the relationship of how the accounts flow from the beginning balance to the ending balance. Okay. For example, last time we talked about the allowance for doubtful accounts. Okay, you've got the beginning allowance account. It will increase as a result of bad debt expense, and it will decrease as a result of accounts being written off. Very good. And that gets down to end. That's in your notes from last time. Okay, so make sure you pay attention to that in the Chapter 2 stuff. Also, make sure you pay particular attention, and I mentioned this back when we were in there. Pay particular attention to the equity section and the statement of cash flows. Okay? We haven't talked about the statement of cash flows all that much yet. We'll do that in Chapter 8. But as far as what we have covered, make sure you understand the equity section, which most people who don't have sophisticated training don't understand, and make sure you understand the statement of cash flow, as far as we've talked about it so far. All right. So make sure that you are on top of that. We talked about, of course, on the financials. Don't out-trick yourself and say, well, it's a multiple choice exam, therefore he can't ask me to prepare financial statements, therefore I won't worry about that. Okay? Well, it's a true statement that it's multiple choice, so I can't ask you to prepare the statements, but I will ask you enough questions to know whether or not you can do that. So, for example, just like you've seen in your homework, we've done some of this in class, what you can expect is a list of accounts, okay, probably in alphabetical order. And then questions like calculate current assets, calculate long-term liabilities, calculate operating income, so forth and so on. Okay, so the major categories on the financial statements. So make sure that you understand, among all those other things, the income statement template. Remember that? Sales minus cost of goods sold equals gross profit minus Operating expenses equals operating income, also known as earnings before interest and taxes, minus interest equals earnings before taxes, minus taxes equals net income. Yeah. Now, for our purposes, we'd also have some other gains and stuff in there below operating income. So make sure you look at that. So very good. All right. So you can expect questions about any of those. Calculate gross profit, calculate operating income, so forth and so on. In chapter 3, I introduced you to some basic ratios that decision makers use. So you need to know those ratios, of course, the ones that we talked about in there. Kind of the gist of the ratios is make sure that you can calculate them and make sure that you can give me a basic interpretation of them, which means is a higher ratio good or bad? Okay. For example, this morning we've been talking about the return on equity, the return on assets ratio. Okay. Well, if it's your business or even a business that you're thinking about investing in, would you look for a higher or lower return on assets? Higher. Higher. One of the couple of the ratios we talked about that I emphasized in chapter 3 was the debt to equity ratio and the debt ratio. Okay. I told you that those ratios were a measure of, well, it considers the use of debt, but the implications of it, one word, risk. Risk. Those are indicators of risk. Okay? So the more debt a company uses, the higher the ratio, therefore the higher the risk. Okay? And something else you'll talk about in 3403 is risk isn't necessarily bad. Okay? But you need to understand risk in order to control risk. Okay? And those two ratios are measures of risk. Okay? So higher the ratio, more risky the business. Okay? And so forth and so on. Okay? So make sure that you can do that. And the chapter 5 stuff, mostly we just talked about that. Okay? So the cash and cash equivalents, we went through examples of what those are, the definition, all that kind of stuff. Effective bad debt expense, effective the interest accrual, and what was the other one I was forgetting? I guess that was it. Okay, so we've pretty much gone through that. Okay, so questions. I know a couple hands popped up. Kind of, yeah.
I know that in one of the classes you mentioned accounts receivable turnover ratio.
Yeah. Account receivable turnover, inventory turnover. Yeah. Yeah, you should know those. Yes. Okay. Was there? Yeah. Yes.
My question for you is, what material do you recommend we review?
What?
Remember, do you recommend textbook homework for lectures, or
The material that I recommend that you go over, and I'm not being sarcastic, the material I recommend you go over is all the material we've covered to date. In addition to what not in addition, but I just emphasized some material, but everything on the exam has been covered in class or on the homework, okay? And I covered it in class not because I like to listen to myself talk. And I'm actually, I don't mean that sarcastically, I'm being serious about that, yeah.
So you said, since it's multiple choice, we don't prepare the statements, but you would give us, like, this happened on this day with this account and that account, and then, like, a full list?
Well, I could do that too, because yeah, her question is about preparing the financial statements. Now, what I said was that I can't ask you to prepare the statements, but I can and will ask you enough questions to know whether or not you can do that by giving you a list of accounts, asking you things like calculate property, plant, and equipment, calculate current liabilities, so forth and so on. Because the importance of that is understanding and believe me, the accounts we've talked about so far are basic financial statement accounts. You'll see them on just about every set of financial statements. The importance of that and the point of that is to understand where they go on the financials. Understand that account receivable is not a long-term liability. Okay, that's the point of that. So that answer your question? Okay. Other questions? Other questions? Yeah. Calculator, and you can bring calculator, and they'll give you scratch paper over there in the exam. And was there other questions? Yeah.
Okay, so, like, I have this calculator, like, we have to have
Yeah, you should have gotten your financial calculator weeks ago. Okay. Well, you should have learned how to use it. In another context, I heard something recently that I liked, and that is just because you own a guitar does not make you a musician. Okay. So when I say get the calculator, I mean that assumes that you mean learning how to work it. Yeah. The homework, yeah, the practice problems be the homework, and the examples that I've given in class would all be good practice problems. And which brings up a good point, because the homework, even though it's already, the due date is already passed, you can still go back and work the homework problems. It's not going to be scored, it's going to count score, but you can go back and you can do that all semester long. So.
Will it tell us if we got the right or wrong answer when we submit it? Will it still give
Yeah, it should tell you the right or wrong answers. Yeah, okay. Yeah. Yes, you need to memorize all of the formulas. Yeah. But after you've done a half dozen problems, you know them. Okay. All right. Okay. That's it. All right. Well, listen, good luck on the exam. I will be anxiously awaiting the results on. So no class on Thursday. We will have class on Tuesday because we're going to need to continue moving forward. All right. So have a good rest of the week. I'll see you guys next week.